looking at where we're at and the markets and equity markets specifically being close to or at all-time record highs, I think there's a lot to go into learning about market protection for retirement in 2025. And when we look at it, retirement is a point in your life that doesn't allow the luxury of time to make up for mistakes. If you're younger and you're 5, 10, 15 years till retirement, what happens in the market today or tomorrow is that sequence of returns has little impact the longer the time frame that you have. But if you're looking for retirement here in the near future, or you just recently retired, you need to really learn about some of the market protection strategies that are out there. And the good news is that there's a lot of great opportunities, and some maybe you've never even heard of. So if we start on the safer end of the side, and we look at what I would refer to as principal protected options that are out there, some of these can be built upon for the foundation that you have for part of your overall plan. The great news is, with where we're at here in 2025, what we have seen is we've seen fixed income rates still are extremely attractive today. I love the concept of a laddered portfolio. I had a gentleman who had come into the office the other day and had been referred to us, had a lot of money that was built up in his liquid savings account. And I believe that his bank was paying him almost 0.00 nothing, right? And if you don't proactively go out there and look for making your principally protected money work harder, you oftentimes find yourself getting lower interest. What we did is we explained to him the concept of a laddered approach for your safe money. Within the laddered approach, we took a third of the money and ultimately we redirected it to a high interest money market account. We took another third of the money and we invested into a 3-year fixed account. So you could get like a 3-year fixed, or what is called a multi-year guarantee annuity that would pay a fixed rate of return for the next 3 years. And then the third bucket is we took and we put money inside a 5-year bucket of money. And that 5-year bucket of money, again, offered a fixed rate for 5 years. So regardless of what the Federal Reserve does with interest rates, he knows where he's going to get it. And simply taking that bucket approach, the reason I like that approach is, number one, is that first bucket, he's got plenty of liquidity. So, what if he has an emergency? What if the basement floods? What if he needs to replace a roof? What if he, needs to replace a vehicle? He's got that liquid money market account. Then he's got money that's maturing at different times in the 3 and 5 year bucket of money. So that is one of the ways to make that foundation work really hard for you, is use a laddered type of an approach. I mentioned the word annuities, and you can also use annuities strategically as well. So when you look at annuities, there's what is called fixed annuities. They're oftentimes called a multi-year guaranteed annuity. What a fixed annuity is, or a multi-year guarantee annuity is it's an insurance contract, and what they do is they offer you a set rate of return for a set period of time. You could pick 3, you could pick 5, 7, 10 years, and you would get whatever that interest rate is for that fixed period of time. I have been completely impressed with what my son Andrew, who runs our fixed income department, has been able to find as an independent advisor and agent on the fixed income. If you have fixed money and you're not earning somewhere in that 4 to 6% range here in 2025, you really could be missing out on opportunities of how to make that money work harder. The next thing that you have in the insurance companies of America is you have a product called an indexed annuity. And so what an index annuity does is an index annuity allows you to participate in an underlying index when the market goes up, but then protects you against losses when the market goes down. I would say index annuities, those most commonly are used for that 7 to 10 years. So again, building out that laddered approach, an index annuity provides that principal protection, and it typically is going to protect you most common in that 7-year to 10-year time frame. Then when you go over and you look at the market as a whole, one, I would say for the most part, for the last 7 years, bonds have not been extremely attractive, especially if you're looking for growth as part of the portfolio. Now, depending upon what interest rates do and or looking at it for income, I think there are some reasons why bonds could make sense as part of a portfolio. In fact, I do a video where we talk about taxes and the difference between, how CDs and money markets get taxed versus like municipal bonds. There can be some reasons there, but if you want to have some defense but still have growth potential overall within the equity markets, one of the things that you might want to consider is what is called a buffered exchange traded fund. It's also known as a defined outcome exchange traded fund. And what these do is these can allow you to limit some of the losses that you have if and when the underlying index goes down. The most common used is the S&P 500 index, but they have a variety of different indexes that you can look at. And so what it can do is it can help you offset the first, say, 10 or 20% if the market goes down. In exchange for that, what you end up with is you get a cap, which would be the maximum return if that underlying index goes up over a defined period of time. The most common that I've seen that are being used in the exchange traded fund for buffered or outcome ETFs also tend to be usually like 1 year type reset options. And they offer some flexibility and liquidity. So, a buffered or defined outcome, you're going to take a little bit of risk, but it's going to allow you to add a little bit more defense into your portfolio than just getting complete overall market exposure. When you look at the investments that you have within the stock market, I think one of the ways that you're going to be able to help have some market protection is, again, knowing what you own and knowing how you're allocated. Use the S&P 500 index right now. What you have is you have a small group of stocks, relatively 7 out of the 500, that make up over 40% of the performance. So the challenge that you have with just the broad market and a market weight portfolio is you could get pushed into unnecessary risk with your portfolio. It's could be best example is back in like 2000 when technology blew up. Everybody had technology. A way that you could get more market protection is to equal weight your portfolio. An example there is instead of 7 stocks representing 40% of the portfolio, let's just say you had 100 stocks for simple math. An equal weight portfolio would be to put 1% into each stock. You equal weight it out so you don't have one stock that represents too much. And then know what you own. So the things that you should own in this environment, not only equal weight, but I think that you want to own companies that are cash rich. Look at the financial balance sheet of the companies that you're working with. You want to invest in companies that have low debt, companies that have really good profit margins. You can be a little bit more defensive if you look at companies that are needed on a daily basis. So, the utilities, your healthcare, your waste management, those things that you need that you're going to have no matter what, your grocery stores, your beverages, your cleaning supplies, or focus on companies that have a competitive advantage, things that stand out and that are really kind of overall dominating their market. So when you look at the market at an all-time high here in 2025, I think now is the time to make sure that you understand what is some of the market protection you can have for your retirement. And if you're not sure what you own, the best way to figure that out is to get an independent portfolio analysis. And you want to do it, again, while the market's at a high. Don't wait till something bad happens and then decide to make a move. Now is a great time for market protection for retirement in 2025.